For part 2 of our chapter 14 video lecture, we're going to talk about revolving charge credit cards. Question: how many of you all have credit cards? Okay. Do you pay your credit card balance in full at the end of each billing cycle? You don't? Okay. Then this lecture is for you. We're going to really talk about how the interest is calculated on the unpaid balance on your credit card. Now, with credit cards, there's the Fair Credit and Charge Card Disclosure Act of 1988, which means that the credit card company must tell you the annual percentage rate that you're paying on the credit card. The interest charges on your credit card are based on the interest rate times the previous month's balance, meaning that if there's an outstanding balance from the previous billing cycle, you must pay interest on that previous or outstanding balance. When you make a payment to the credit card company, the payment is first applied toward the interest that you're paying on the previous outstanding balance, and then on the outstanding principal balance. That's known as the U.S. rule. When you have a revolving charge account, that allows you to buy open-end credit up to the maximum credit limit. So, look at your credit card. What is the limit on your credit card? Is it $500, $750, $1,000, $5,000? Whatever that amount is, it allows you to make a purchase up to the maximum credit limit that is listed on your credit card. Okay. Now, when it is time for you to make a credit card payment, the minimum balance that you have to pay on average is going to be 2% of your outstanding balance. You're saying, yeah, that's not a problem. I can pay that 2% every month. But if you were paying the minimum balance on a credit card, sorry about that, go back. If you're paying the minimum balance of 2% on a credit card, that charges 17% annual interest. If this was your balance, $1,000, $2,500, $5,000, look how long it would take you to pay off that credit card by paying the minimum 2% balance. So, if you owe $5,000 and just paid the minimum balance of 2% each month, it will take you 40 years to pay off that credit card. The total cost, because you're only paying the minimum balance, that total cost would be $16,305.34. So, Professor Reeves, what are you saying? I'm saying if you're going to use credit cards, use them wisely. Pay off the entire outstanding balance at the end of each billing cycle. That way, you do not have to pay any interest to the credit card company. You can thank me later. Now, let's take a look at how the payment is going to be applied to your outstanding balance. Okay? Let's assume you have a balance of $8,000. And you're going to make a payment of 1.5 interest payment, 1.5%. So 8,000 times 1.5%, which is 0.15 the decimal, mean you would have paid, the interest is going to be 1.5% each month, which means that if it's 1.5% each month, take that times 12 months, and that'll give you the annual interest rate. What is it? I'm waiting. What is 1.5% times 12? Yep, that's 18%. So they're saying that you will have a monthly or an annual interest rate of 18%. Divide that by 12, to get the monthly interest rate. So this $8,000 the first month, the interest will be $120. Let's assume you made a payment in the amount of $500. Well, the first $120 of your payment goes toward the interest. Then the remaining $380 reduces your principal balance. So at the end of that first month, you still have a balance of $7,620. So now the next month, you take your outstanding balance times 1.5% to get the interest. Again, you're paying $500 each month. They first apply the payment toward the interest. The remaining amount goes to the principal balance to get your outstanding balance. So at the end of 3 months, although you've paid $1,500, you will still have an outstanding balance of $6,842.81 because of the interest that is accumulated on that credit card balance on a monthly basis. Did you know that? Now you know. Also, with credit card companies, they calculate your average daily balance and then multiply times the applicable interest rate. To do that, they'll look at your previous balance plus any cash advances you may receive, plus any purchases that were made during the accounting periods, minus any payments that you may have made. Side note, cash advances, do not use those if you don't have to, because there's additional fees charged by the credit card company when you use your credit card for a cash advance. Okay, back to class. So once they have that daily balance, which we'll take a look at it, they'll multiply times the applicable interest rate to figure out how much interest they'll charge you for that particular month. Let's just do it. Let's say that you purchased a desk that costs $600. You made a payment of $40. They're charging interest of 2.5% on the unpaid balance. Now that's 2.5% interest per month, which means what would be the interest rate on this card on an annual basis? Take 2.5% times 12 months. Yep, this credit card has a 30% interest rate. So to do our calculations, you would take the outstanding balance, which is the $600. The interest is 2.5% of that, $15. You paid them $40. So again, the first $15 goes toward the interest. The remaining $25 reduces the outstanding balance. So at the end of the first month, you will owe $575. For the second month, they'll take the outstanding balance of $575 times 2.5%. You're going to pay the interest $14.38. Again, you're paying $40, but the first $14.38 again is applied toward the interest. The remaining $25.62 reduces your principal balance. At the end of 2 months, you will owe $549.38. The moral of the story is when you have credit cards, especially with a high interest rate, you want to pay off the outstanding balance as quickly as possible to avoid paying a lot of interest on the actual credit card. Calculating the average daily balance. This can be pretty tricky, so pay attention to this. Let's say there's a 31-day billing cycle. The balance from the previous month was $210. You paying attention? All right. You made a payment for $50. You bought some staples for $30. We don't have no staples. Okay, never mind. Then made a payment for $10. And you then took a cash advance for $60. Now, I just told you all, do not do cash advances, but apparently you didn't listen. And they're saying that the interest rate on the average balance is going to be 2% per month. Let's look at how do you calculate the average daily balance on this type of situation. So first, the 210 was the balance for 7 days. Okay, keep these days in mind. So August 20th was the billing date. You made a payment on August 27th. That's a difference of 7 days. So for 7 days, the amount owed was 210. So we'll take 7 days times the 210. Then you made a payment for $50. We brought the balance down to 160. But after that, you charged those Durham staples for $30, brought it back up to 190. So for 4 days, the balance was $160. Still with me? Yes? All right. Then you made a payment of $10, which brought the balance down to 180. So the 190 was for 5 days. I'll go back because between 831 and 95 is a 5-day time period. So your balance was, oops, wrong way. Sorry about that. So your balance was 190 for 5 days. Then you made the payment for the $10 that brought it down to 180. But then, against my advice, you made a cash advance for $60. It brought the balance back up to 240. Now, this is the 31-day billing cycle. These other transactions took place within the first 21 days. So the balance remained at 240 for the last 10 days of the billing cycle. So you multiply the number of days times that balance to get what's known as the extension. You're going to add those amounts all together to get a total of $6,360. Divide that by the number of days in the billing cycle being 31 days. That would give us an average daily balance of $205.16. You take the average balance times the applicable interest rate, which would be 2% in this case, the finance charge equals $4.10. Now, this is a lot of calculation. I know you're saying, that's too much. Stop your crying. We now have software that does this for us, but because you're in my class right now, you must do this on a manual basis. Okay? So that will conclude our chapter 14 lecture. Read the supplemental material. Make sure to do the practice quiz that you can do over and over again and work out as many problems you possibly can to make sure you understand the concepts that's being covered for this chapter. That's all for now. Talk to you later.